Once again, this is Prince Dice here, the Royal Financial Investment Group, coming to you guys with another great, awesome video. As you guys can see already on the stream, and probably through the title, this video is going to be about the negative interest rates talks and things that are going on down up in Washington, well, around the world, but mainly kind of being put on the table for Washington. But I don't have a lot of time. I definitely know you guys have a lot of time, so let's jump straight into it. So, as you guys already know, well, you probably don't know. Let me just bring everybody up to speed. The reason why I'm making this video is because someone asked me, said, "Hey, Prince, I see this talks of negative interest rates. What should we do? What could we do? How could we profit from this? Or what you think is going to happen and stuff like that?" So I said, "Okay, sure, I can definitely put a video up about it." So I decided not to put the camera on, just something audio. You guys can just sit back and listen to it, and drop your comments below and all of the good stuff like that. But anyway, so negative interest rates. Let's first get into what they are. So as we know, the Federal Reserves up in Washington right now, ran by Janet Yellen. We just recently raised our interest rates, right? So the whole thing about interest rates is it gives the federal government a way to control money that's in circulation. It's a way to boost the economy, and it's a way to slow down the economy. Going into 2008, I want to say interest rates was around like 3 to 4%, and we had a big crash in 2008. So what banks do is they lower interest rates. Lowering interest rates is a way to stimulate the economy. Now, in 2008, we pretty much put our interest rates to non-existent, zero. So which means that banks can pretty much use easy to loan money. The banks they borrow their money from the Federal Reserve. The Federal Reserve, they take that money, they loan it out to business people and stuff like that. So now money is cheaper to borrow, meaning that houses, you can get lower interest rates on houses. Banks can get lower interest rates on loans. They use these loans to expand, create new products. When they expand and create new products, they have to hire new people, so it puts people back to work. Kind of that, it trickle down effect, way to stimulate the economy, right? So, and when a company expands, its stock value rises. People that invest in the stocks, when people see the stock value rise, that attract new investors. When people see, wow, this market's going up, it makes people want to invest, decrease unemployment, stuff like that. It's a way to stimulate the economy. You guys catch the drift, right? So, but going without interest rates for a long period of time is very, very bad. So not the economy, but the Federal Reserve was kind of worrying about, hey, what is a way that we can slowly implement interest rates, which they just did in December, right? But around the world, global markets right now not doing too well as far as China, your Japan, your Europe, Greece, definitely a lot of them are struggling at this present time. So they ventured off into something called negative interest rates. Negative interest rates is, usually when you go to the bank, right? You say, hey, I want to borrow a loan for $1,000. The bank says, okay, here you go. Here's $1,000, but it's going to come at a 10% interest rate. 10% of $1,000 is $100. So when you pay that loan back in a year, you're going to pay back $1,100. The principal, purse, and the interest rate. And it's the same way when you put your money into a bank. You put your money into the bank for holding your money there. The bank gives you 0.25%, gives you a small interest rate. Now, when you venture off into negative territory, it actually charges the person. It works backwards way. It charges you to save your money. This is a way to stimulate the economy. So if I'm saving up all my money, because when the economy does bad, people get scared, people see the market crashing, all this volatility in the market's going up one day, down the next day, is crashing one day, is you don't know what's going on. So people like to pull their money out of the market, and they like to set back on, maybe save it, or they move it to things like precious gold. People love to go back to gold, which if you've seen, you heard in previous videos when I said this last year and stuff like that, or year before that, gold will spike as the market starts to decline. Anyway, people start to run to more conservative avenues of saving, safe havens, right? So if a bank says, hey, I'm going to charge you for saving your money, guess what people are going to do? They're going to move their money somewhere else, take out a saving, and the objective is hopefully they'll take out a saving and put it into their business. Hopefully take out a saving and invest, stuff like that, to help stimulate the economy, get the money out of the savings account to help push the economy. So it's a way to stimulate. Now, let's put this in perspective to what's going on in the States. We recently just raised interest rates in December. They say, hey, the economy's doing good enough. We can kind of slowly bring in interest rates up to 0.25 and throw on another 0.25 every following year as the economy does well, which is great. Because by them raising interest rates, that means that the economy is doing pretty well, right? Which we believe. Now, in the most recent, in the chairman Janet Yellen's most recent interview or proceeding, or whatever you want to call it, meeting, Fed meeting, she essentially said, hey, well, negative interest rates is definitely on the table. That scares people. Why? Are you telling me first you just raised it? You said the economy was doing well enough to raise it. Now you're telling me you may consider negative interest rates? Why would you consider negative? That's going to scare investors. What's going on? What they know that we don't know? What type of economical data that we don't have, right? So that itself creates volatility in the market when people are like, okay, the message that you sent out. Now, I've noticed something, just to slip off topic for a small, brief moment. Alan Greenspan was the chairman before Janet Yellen. And from my understanding, the Fed used to only do these big federal meetings and press and all that stuff like that, maybe like once a year, if that, if I remember correctly. And part of the 2008 collapse and the recovery was that they start wanting the Federal Reserve chairman to come speak with them every quarter, which is cool, which is fine. But this is what contributes to the volatility that we see in the market. Every 3 months, everybody's trying to guess what the chairman is going to say. Everybody's trying to interpret what the chairman is going to say. I mean, even down to one word. One word she says could send the market in one direction. That has increased volatility dramatically, right? So it's a good thing that, Congress is like, hey, we need to be more involved. We kind of let the whole laissez-faire, just let the economy run, let the Federal Reserve do whatever they're doing, and we never really paid attention to it. Now we need to have a more hands-on approach to where every quarter we need to see what's going on and how things are going. Those things, when she has those meetings, swings the market. So that's just something I noticed, just a quick little side note, but back on topic. So let's look at the countries around the world. Europe, they started negative interest rates. Japan on January 29th or 28th, they came out and said, where I'm at right now, they said, hey, guess what? We're going to move to negative interest rates. And which other company did it as well? China. I think China was talking about negative interest rates as well. Now, when you look at what happened to the economy, it started an immediate sell-off. People started to sell immediately out of fear of the unknown. The reason why is I think that it will, in the long run, it will make the economy better, but I think in the short run, it will send the economy down because of fear. Right now, everybody's fearing. They're trying to time out when is the next crash coming, and then all of a sudden, you got Janet Yellen talking about we're going to venture into negative interest rates, which is a sign of, hey, the economy is not doing that well, and that scares people. That's going to scare investors to probably move to more conservative investments. If I was managing $500 million, and now if I save my money, my clients are going to lose money. I'm not going to have that money there. I'm going to venture off into some type of investment. Where can I place this money, right? First place, a lot of investors I think they're going to go back to precious metals. You're going to start seeing precious metals go up higher, as you've seen already this year. They're going to venture off into precious metals. So that's something that you can do to profit from it. Another thing is bonds. We know that interest rates and bond prices go opposite of each other, like the seesaw. So when interest rates go up, bond prices go down, right? When interest rates drop, bond prices go up. So if you're predicting that bond interest rates are going to go down, you could invest, and as interest rates drop, you can make money off of the price of bonds going up. Bonds is another way. It's a conservative way of investing as well. Grade A bonds, corporate bonds, stuff like that. So another thing you could think of, you're into real estate. If you don't want to go out and buy a house, or you don't feel like tying yourself up into the actual real estate market, but with low interest rates, is a perfect time to go into real estate and buy houses, because we all know one day interest rate will return and come back up. Another thing you may want to do if you say, hey, well, I don't want to get into real estate, you can look into REITs, real estate investment trusts. I have a video on that as well, how to invest in real estate with E-Trade, because you can take advantage of the very low interest rates you can borrow money for on a house. And as the housing market recovers, you can also take advantage of interest rates coming up. And you can get in pretty much at a low interest, get yourself a fixed mortgage now at a low rate. So these are things you can do to take advantage of negative or low interest rate things. Another way you can do it is you can say, I think that will increase volatility in the market, that the market will decline, which you can go to things like gold, or you can I have a video called How to Invest Against the Market, where it's a lot of bearish strategies in that video, talking about bearish ETFs. And we're talking about placing put calls, stuff like that, that you will actually make more money as the market decline than incline. So those are things I just kind of wanted to bring up and kind of touch on the topic of negative interest rates and how they affect the market, how they affect you, and how in some ways you can take advantage of it. So I don't want to keep the video too long as always. Thank you guys for tuning in. Let me know if this was a good video. If this video was good, bad, if it sucked or whatever. Thank you guys for the feedback. I know somebody told me about, get a better microphone, ways to get a better microphone. I'm definitely going to look into that when I return home to Hawaii. Definitely thank you guys for tuning in as always, but I don't want to ramble on here. Until the next video, you guys already know what to do. Peace. Be safe.